Okay, these last two videos cover the last part of Chapter 11 before we move on to Chapter 12 next week. As part of the new study guide this year, you need to be aware of the strengths and weaknesses of monetary policy. So just like we looked at it for budgetary policy, we're going to look at the strengths and weaknesses of monetary policy. So you can evaluate how monetary policy might be effective during a trough, why it might be less effective than budgetary policy, for example. So some key strengths of the monetary policy. One, they're politically neutral. What I mean by that is the RBA panel do not get elected by the public. There's some really nice highlighting, Malathi, just around the politically neutral. The RBA are politically neutral, which basically means that any decision that they make is free from political bias. So they don't, they're not influenced by, they're not trying to buy votes, so they're not doing what's politically popular. They're going to do what's best for the economy. So they're going to work in a way. So if inflation is too high, they're going to work to tighten monetary policy regardless of whether it's unpopular, because they don't care about winning votes. They only care about what's best for the economy. So that's a really key thing, is that they aren't influenced. Only under exceptional circumstances will the government intervene based on what the RBA does. Other than that, they are completely politically neutral. The second thing is they have a short implementation lag. So unlike budgetary policy, where it can take ages to get through the Senate and the two houses, the House of Reps and the Senate, monetary policy has a really short implementation lag. What that means is once the RBA announce their intention to raise or lower interest rates, they can immediately enter the cash market and bring the actual cash rate close to their target. So from the moment they announce, all right, we're going to loosen monetary policy, we're going to reduce interest rates to 1.5%, they can quickly enter the cash market and they can manipulate. So if they were loosening monetary policy, they would be buying securities to increase liquidity. That process is really quick in terms of how quickly they can change the actual cash rate to make it match their target after they announce a lower or higher target cash rate. So they're politically neutral, short implementation lags. Monetary policy has a huge influence on expectation. So what I mean by that is, even if the governor just hints that they're going to raise interest rates, it can deter spending. Even if the RBA just hints that they're going to decrease the cash rate, it can have an impact on spending. So it has a big influence on the behaviour of economic agents, and just possessing, when the governor comes out and expresses his concerns or hints that he's going to lower or increase interest rates, it will have a big impact immediately on consumers, investors, borrowers and lenders throughout the economy. Another strength of monetary policy is that it's really effective in manipulating aggregate demand during a boom. Monetary policy is more effective during a boom than a trough. In a trough, there are things that limit its effectiveness, like the fact that consumers might not spend the extra discretionary income they receive if we have lower interest rates. They can't force people to spend. But during a boom, it's really effective because the RBA are able to raise rates, decrease people's discretionary income, and that can have a big impact on their willingness to borrow, as well as through the cash flow, their discretionary income to spend. So monetary policy is the primary policy during a peak to achieve domestic economic stability. Higher interest rates have an immediate impact on discretionary incomes and have a big impact on households that have debt. It's the best policy possible for reducing aggregate demand in a boom, and is better during a boom than it is during a trough. We'll talk about the weaknesses in the next video.